Aloha, I'm Carl Bonham, the Executive Director at UHERO, and I'm here today with a UHERO focused video talking about our fourth quarter forecast report. And the global outlook continues to darken, but the prospects for Hawaii are really not that different than what we reported on in the third quarter. And what we're watching is high inflation, rising interest rates, and this global battle on inflation. This chart actually shows the U.S. Consumer Price Index in orange, and you can see that peaked at over 9% in the summer of 2022. We're going to get another CPI report the day after I shoot this video, and we think that that's going to show continued decline in the rate of inflation as some of these transient components from high gas prices and high oil prices and rising prices for used cars and new cars, as those go away. Actually, oil prices are back to where they were before Russia invaded Ukraine. That will bring inflation down. And the real question is, how fast does it come down? And how much does the Federal Reserve need to raise interest rates? The federal funds rate is the interest rate that the Federal Reserve Bank targets. And their target is currently at 4%. By the time this video comes out, we think it'll be at 4.5%. And when they meet this Wednesday, they'll also decide how high they think interest rates are going to go during 2023 and how long they're going to stay elevated. And so what really matters is how persistent inflation is. Do we get inflation coming down fairly quickly, or does inflation in the services sector of the economy and wage growth hold inflation up and lead the Federal Reserve to push interest rates higher for longer? And really those interest rate effects, we haven't seen them in the broad economy. What we've seen is mostly in housing and in foreign currencies. The longer they stay elevated and the higher they go, the more we think that's going to show up in things like consumer spending and will lead to a mild recession for the U.S. economy in 2023. Starting in the second quarter, we expect for the whole year that the U.S. economy will basically not grow. We'll see zero growth in 2023, and then growth will resume near the end of the year, and 2024 will be better. The interest rate effects are primarily showing up in housing. They've really thrown the housing market into complete turmoil, with home sales declining around 40% nationally and in Hawaii. Resales have fallen off sharply, home price growth has fallen off sharply, and affordability, which is what this figure is showing, has really collapsed. This is actually the maximum price that could be charged on an affordable unit that's built in Hawaii and targeting someone making 80% of the area median income on Oahu. And what you see is that price has plummeted, over a 40% drop in what a builder could sell that home for. And so builders are being squeezed by the price of what they can sell a unit for declining, while at the same time their costs continue to be elevated. Their costs are going up because of rising interest rates, but also because of all the input costs. And so what that means is that residential housing construction is going to slow. Some of these projects that have been in the works or been planned will either slow down or they just won't happen. And so residential building will be very, very flat for the next couple of years. Fortunately, we see a significant boost in federal spending in the islands from the Infrastructure and Jobs Act. That money is beginning to flow, and federal spending for DoD projects such as at the Pearl Harbor shipyard, but also infrastructure in DoD facilities across the state. And that spending is so large that it will completely offset the decline that we expect in the visitor industry. It will more than offset the decline in visitor spending that we're anticipating. We've been talking about the visitor industry sort of having a lagging recovery now for the last 6 months to a year. But if you look at visitor spending, which is what we really care about, and you adjust it for inflation, in the third quarter of 2022, it was actually higher than it was pre-pandemic. And so by that measure, we really have recovered. Total visitor numbers are still below pre-pandemic level, and we're of course still waiting on the recovery of Japanese visitors. So in this forecast, we have pushed back the recovery of Japanese visitors all the way to the third quarter before we reach 50% of pre-pandemic levels. Now, at the same time, the U.S. visitor has been more resilient. We saw stronger growth in the third and fourth quarter than we had expected in our last report. And the overall path for the visitor industry is really not that much changed from our third quarter report. And so, as I said, it's fortunate that the spending from construction is going to offset that decline in visitor spending, and we really only expect a small decline in job growth. We really expect job growth to just pause. So if you look at the orange line here, this is total non-farm payroll statewide, and after posting an almost 6% growth rate in 2022, we expect the growth rates to slow markedly. And if you look at the line, it just completely flattens out. So basically, starting in the first quarter of 2023, instead of growing jobs at 8,000 per quarter, we're looking at maybe 1,000 per quarter in 2023 and 500 per quarter in 2024. So it's really a complete pause in job growth, only a small increase in the unemployment rate. And that's really just a slowdown, right? Not an outright recession. But the uncertainty around this forecast has increased pretty dramatically. The sort of best case scenario would be that inflation comes down really quickly and the Fed is able to raise interest rates more slowly and not raise them as high and bring them down more quickly. And what that means is that you could actually avoid a U.S. recession. That would sort of be a soft landing scenario. And then on the other hand, persistent inflation that goes on for longer and is more intractable, it's harder for the Fed to get inflation down, means higher interest rates for longer. It means a bigger impact on labor markets. You see more layoffs, a bigger drop in consumer spending, a deeper U.S. recession. And in that scenario, you're probably talking about a recession in Hawaii as well. Mahalo and happy holidays and best new year for all of us. Aloha.